How's everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to be taking a look at basically the outlook for 2026. I have a series of 8 articles from S&P Global looking at what they call Big Picture 2026. And we're going to run through a number of topics very quickly. Now, these articles are all just like one page, very short little blurbs on a number of topics, but we are going to be going through, if we could go through these, so sustainability outlook. We're going to look at the M&A, mergers and acquisitions outlook, supply chain outlook, equities outlook, debt markets outlook. We're going to look at AI outlook. We're going to look at commodities outlook, basically through the AI lens, the prompt, AI prompts, thermal power reconsideration, and finally, the chart stopper, the private market outlook. Private credit shakes up banks. So we'll wrap up with that last article. So now. But let's go back to this one at the very beginning here. So big picture 2026 sustainability outlook, weathering short-term volatility. So sustainability-minded companies and investors continue seeking to understand what factors will impact their success beyond quarterly reporting cycles or political terms to create businesses that prosper for decades. These factors range from climate risk, decarbonization, and net zero strategies to nature impacts and dependencies and sustainable supply chain management. Sustainability gained momentum in the corporate world following the 2015 adoption of the Paris Agreement on climate change, providing investors and market participants with a clearer view of companies' non-financial risks and opportunities. A decade later, geopolitical volatility is reshaping the sustainability landscape. As in other words, we found out it was all BS. This will have implications that last well beyond 2025 for clean technology. You better believe it will. Investor sentiment, corporate strategy, and adaptation and resilience efforts. So, again, I'm not saying that you should forget about all that stuff, but again, I've never been a believer in the climate hoax or the climate change narrative, rather, that climate change is destroying the world, we have to kill all the cows. Like, yeah, it's ridiculous. I've always believed it had more to do with carbon taxes and control than it did to actually do with climate change. But that's just me. That's just my 2 cents, whatever. Okay, so we'll move on here. So big picture 2026 M&A outlook. So big deals drive resurgence. So while deal making has not lived up to expectations in 2025, hopes for the future remain strong. Optimism for a picked up deal making was high in late 2025, with valuations remaining elevated and the market expected further interest rate cuts by the U.S. Federal Reserve. The sentiment was similar toward the end of 2024, but activity never quite fired on all cylinders in the year that followed. Deal volume remained subdued with a lack of middle market transactions. However, the total value of M&A is on pace to record a second straight year of solid growth in 2025, thanks to outsized transactions. A similar dynamic was at play in 2024 when the total number of transactions increased 5% year over year and aggregate value jumped 17%. The sentiment for an M&A rebound is once again gaining steam. The revival that was expected in 2025 was sidetracked after President Trump's tariff announcements. However, the market adjusted, reactions to economic news became more muted, and large deals were struck throughout the year. Stability should allow deal makers to engage in transactions with greater confidence. Additionally, ongoing interest rate cuts are expected to lower financing costs and enhance valuations, further encouraging deal making, particularly among financial sponsors. The demand for AI capabilities is also driving M&A activity, as is consolidation in the critical minerals space. So yeah, again, I think we are going to see a really robust. I think M&A for 2025 is going to end up being actually a pretty decent year. I think we will see a robust 2026 in terms of M&A with Trump's administration coming in this year, with the de-escalation and regulation. Just a more positive, more pro-business business vibe in general. Interest rates coming down a little bit, valuations going up. So I do believe that 2026 will be a good year for M&A. Big picture 2026 supply chain outlook. Act strategically, don't react tactically. So supply chain decision makers became more tactical in 2025 due to the need to offset 907 billion in estimated tariff costs. While uncertainty around tariffs will remain a part of supply chain planning in 2026, increased momentum from global free trade deals are expected to lead to export growth and sourcing opportunities. Companies are expected to return to long-term sourcing investment decisions in 2026. Free trade deals have helped emerging economies develop in the past, but the low cost labor advantage of these markets is eroding in the face of robotic manufacturing. So the trade policy environment will become more supportive of global supply chains in 2026, even if a full resolution of U.S. tariff uncertainties remains elusive. U.S. import duties are here to stay for the foreseeable future, but a series of lightweight trade deals based on tariff concessions in return for purchase and investment commitments will provide an offset. Meanwhile, fully fledged trade deals across Europe, Asia, and Latin America provide new possibilities for collaboration. So, couple things on this real quick. So number one, people need, and I've been saying this for a few months now, people need to accept the fact that we are in a paradigm shift as it relates to trade and tariffs. The United States wants to bring manufacturing back. You have to accept that. Okay. Corporate leaders need to begin to accept that. They need to begin to look at how do we bring the manufacturing of our product back to the US? How do we bring our supply chains back to the US? This is going to become a reality because if you move it back to the US, how much do you pay in tariffs? Zero. So that tariff cost is going to get pretty heavy unless you start to move stuff back. The tariff are also going to make it more affordable to bring it back and make things. The tariffs are also going to make exporting certain American products and goods out to Asia and Europe much more profitable and should be better business. So we should see a lot of good things, but that does not mean it does not come with some short-term pain over the next, say, year or so as this all begins to flesh itself out. So we shall see, but just a couple thoughts on there. Big picture 2026 equities outlook. So cautious optimism fuels rally. So less than a week after President Donald Trump on April 1st announced a package of tariffs on nearly all of the U.S. global trading partners, stock markets declined steeply with little hope for a quick turn. Who wrote this? Obviously that was ridiculous. And now we're all back to all-time highs. Enough said about that. Kind of a stupid take on equities here, if I do say so myself. Here's the real concern with equities: the AI bubble. The AI bubble, I think, is a major issue. You know, the capex, the capital expenditures through the big seven, and all this spending on AI has gotten, in my opinion, completely out of control. And we don't know if there's a payoff there. We don't know if there's a payoff there. So that's a big issue. That is what I see as the biggest challenge to equities into 2026. If that AI bubble blows up, look out, man, because that could be a bad couple weeks for the markets. Big picture 26 debt markets outlook. Resiliency persists as risks mount. So credit markets are showing surprising resilience heading into 2026. Debt issuance remained healthy in 2025 as companies' access to credit markets are largely unfazed by economic and geopolitical concerns. Still, the uncertainty that marked 2025 is likely to persist in the new year. Challenges may also intensify in the form of new pressures from tariffs on businesses and consumers, as well as the potential for monetary policy to remain tighter for longer. So yes, I mean, there are definitely some challenges going into 2026 for the debt markets. Like on the one hand, you got $38 trillion in national debt. We're still running a $1.7 trillion annual federal budget deficit. We have to roll over that debt in the treasury market. So we have to do the treasury auctions, the bond auctions. You know, we got to constantly roll that debt into longer term treasuries, still managing those interest rates as it pertains to that. We also have banks have issues with some underlying issues with credit quality, private credit market, subprime auto loans, and looking a little shaky at the moment. So there are definitely some issues that are underlying there in the credit markets. Also, I have to say, The Federal Reserve, Jeremy Powell, he drained all the liquidity out of the repo market. I would be keeping a big eye on that one. I'm watching that very, very closely. Okay, that he drained all, not a little bit. He drained all the money out of the repo market by reducing the Fed's balance sheet. That's a problem. That's gonna be a big problem, and that's gonna catch a lot of people sleeping. It's not going to catch me sleeping, but it was going to catch a lot of people. You see a lot of people on CNBC and Bloomberg going, "What happened? We don't know. We don't know how this happened." All right. AI outlook, unleashing agentic potential. So AI's growing dominance in technology and market discussions is hard to miss, but even more transformation of AI technologies and ecosystems is on the way. While the technology shift to agentic functionality is in early stages, understanding how this is shaping AI development and technology markets is critical. Driving the pace of adoption are enterprises looking to capture the promises of increased productivity and operational velocity. Agents introduce new risks, however, and the density of their activity can increase the strain that AI places on infrastructure capacity and heighten related concerns about sustainability. So let's keep that in mind for a second here. Now let's look at commodities outlook. So AI prompts thermal power reconsideration. So 2 years into the generative AI revolution, the mismatch between data center power requirements and supply has reached a critical point. This has led to growing interest in thermal energy options as evolving federal policy reshapes the energy sector. Momentum continues for the nuclear industry. Gas turbine orders are at their highest levels in nearly 25 years. Coal unit retirement plans are being delayed. The build out of renewables also continues as the U.S. attempts to keep pace with load growth. So the unrelenting load growth has led to a reconsideration of strategic energy priorities in the U.S. This shift is bringing nuclear, gas, and to a lesser extent coal back to the forefront, pushing decarbonization objectives to the back burner. The second Trump administration supports this reorientation primarily through a rollback of federal tax incentives for solar and wind power and a push to minimize red tape for nuclear. So yes, again, we just don't know where this is going. I have been saying for years that we needed to invest more into nuclear, into gas, into coal. We needed to stop closing nuclear power plants. We needed to stop closing coal power plants and reinvest in those plants, bring those plants back, make them better. A lot of people refuse to acknowledge the fact that nuclear technology has vastly improved in the last 40, 45 years. It's vastly improved. We just haven't invested in it. We haven't, because they're like, oh, nuclear, it's polluting the environment and this and that. Nuclear is one of the best, cheapest, most consistent sources of power that we have. Still, it does way better than solar and wind and any of this other stuff that's out there. Not saying that stuff is not important, not saying that stuff can't play its role, but it is not going to replace nuclear. That is just a fact. It is not going to replace the power you're getting from nuclear. Now that you need all this extra power for the AI, for the data centers and everything, you're going to have to continue to reinvest in these things. The question is AI ultimately are we going to see the payoff from AI that we're being promised? That is the big question. And then finally here on private credit shakes up banks. So private credit firms have taken market share from traditional banks over the last several years, but have also supported asset values and bank credit quality. Private credit firms compete effectively for loans that might be seen as too large or too far out of the risk curve for traditional banks. They also can offer bespoke solutions and high-level service that borrowers might prefer over traditional banks. While banks face stiff competition for private credit firms, a number of large institutions have seen their significant growth and sought to partner with them. Private credit firms have grown considerably, especially through support by large private equity firms, creating more competition for traditional banks. While many lenders gripe about ceding market share, traditional banks have also lent directly to and partnered with private credit firms. Depository institutions have also benefited from private credit firms supporting asset values, either by lending directly against commercial real estate properties or purchasing loans at more favorable prices than market participants expected a few years ago. Now, what I like here is just below here, they give a breakdown for loans to non-depository financial institutions, NDFIs. So basically you have, mortgage intermediaries, $308 billion, You got business credit intermediaries, 322 billion, private equity funds, 302 billion, consumer credit intermediaries, 134 billion, and then other loans to NDFIs, 290 billion. So it's a kind of a nice little breakdown of the different segments here in the private credit market. So, but private credit, I still maintain that private credit is a big issue for banks out there. It's gonna cause some nasty surprises in credit quality, and we'll set to see how that plays out into 2026. So, but that being said, that is the outlook here for 2026. I will do another kind of end of year recap episode as we get closer toward the end of the year. I'll be looking at taking another look going into 2026 as we get toward the end of December. But with that being said, I'm going to wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. Have a great day out there, and I will see you again real soon.